guys. So first of all, I'm 10 minutes late because I don't know how to work Facebook. Just throwing that out there. So this is supposed to be about insurance, home insurance, auto insurance, just the basics, figuring out, just making sure that you have what you need, and if you don't have what you need, knowing what to ask your agent for. So I'll go ahead and I'm going to start with home insurance. And like I said, just kind of the basic high level thing. So whenever you get your home insurance, you get what's called a dec page or a declaration page. Sorry, my dog is licking my toes. You get your declaration pages. And basically what that is it just states who your insurance is with, how to contact your agent, what your coverages are, what any exclusions are, like specifically listed coverages that you don't have, and the exact amounts of coverage that you have on each of the different levels. So the number one, like the big basic broad thing is going to be your dwelling coverage. And that is like the structure of your home. That's like your walls, like the walls, the floors, the roof, the actual structure. None of your stuff, but just what it takes to the building materials. When you're looking at that value, agents usually are supposed to take into consideration the value that's listed in the for the county appraisal district, what your improvement value is. They're going to look at that, and every carrier is going to value things a little bit differently. They use estimators for the replacement cost. You want to make sure that you let your agent know. Let's say you just updated your kitchen and you put in like fabulous granite countertops and like some like mega massive fridge and all this kind of stuff that you redid all your cabinets. You need to let your agent know about any updates like that, because that affects that dwelling value. You want to make sure that if something were to happen, that's taken into consideration for you. So your coverage A, your dwelling value. One of the things that goes along with that is an additional replacement cost. And I didn't know this was a thing until I got into insurance. But basically what it is a buffer to make sure that you don't get screwed over if building costs have gone up whenever, like if something were to happen. So example, my parents' house just burned down about 8 weeks ago, I guess. And I mean like gone, like obliterated, the whole thing, top to bottom, gone. And they went ahead and they used their dwelling coverage, that coverage A, and it was not going to be enough to build the house back the way that they had it. However, they had an additional replacement cost. Typically it's a percentage, 25, 50, or 100% of whatever your dwelling value is. So they had that buffer. They were able to build that in, so they are actually going to be able to replace their house. I recommend everybody have that at least 25%. Because again, you just never know. Like right now with this COVID crap, materials are hard to get. So you want to make sure that if you're paying for your insurance, that it's going to do what you need it to do. The next part, it's all listed out, coverage A, B, A through F. Those are the ones that you really want to look at. Coverage B is called other structures. A lot of times I talk to people and they're like, well, I don't have any other structures. I just have my house. Well, do you have a fence? Do you have a carport? Do you have, a little shed? Things like that. That's what your other structures is. That's going to help take care of you. Let's say a tornado comes through and obliterates your fence. I've had that happen. 3 times since we've lived here in Princeton, which is stupid. But that takes care of that. It's usually automatically put on as a percentage of your coverage A, usually 10%. Now, if you've got a super fancy fence, something like that, you want to talk to your agent, let them know so they can increase that. But typically, that's just automatically done for you. You really don't have to worry about it. Coverage C is a fun one. That's your personal property. So think of that if you took your house and you picked it up, turned it upside down, and shook it really hard. Everything that comes falling out, that's your personal property. Every single piece of everything that you have is covered there. Again, it's typically written on as a percentage, but if you have a lot of high value items, like I have a friend that collects shoes. She's got an insane collection of like Christian Louboutins, things like that. You need to make sure that your personal property coverage is going to actually cover all of your personal property. That's going to cover things like your jewelry, your clothes, your rug, your couch, your everything, you know, the stuff on your walls, that kind of fun stuff is covered there. Pay close attention, again, speaking of high value items. Yes, your personal property covers your jewelry up to a certain amount. Usually it's $1,500, $2,500, and that's kind of like an overall total. So if you've got, you know, your wedding ring, you know, if you've got a Rolex, you've got pieces of jewelry that have been passed down, let your agent know, because they've got to make sure that those are on there. Otherwise, you're going to be like, again, you're going to get screwed. You're not going to have everything that you need. So yeah, personal property. And again, that ties into making sure that if you've got, say, specialty items, those need to be, no. Sorry. The other dog's trying to break in here. So coverage D is called loss of use. That will help you in case, again, of a total loss. So like in my parents' case, when, you know, their house burned down, they didn't have anywhere to live. So it covers lodging. So if you have to stay in a hotel, if you need to rent a house, something like that, somewhere to stay, it covers your food. The everyday expenses that you incur because you can't stay in your home. Again, that's automatically put on there as a percentage of your dwelling coverage. So you're able to maintain kind of like, so basically like my house, it's a percentage. It's like 20%, 30%. I feel like I should have written this down, but I didn't. So I'm not going to be going and saying, oh, well, you know, like I can't stay in my house right now for, you know, XYZ claim. I'm going to go rent some like 8-bedroom, 7-bathroom, 3-story, like, I don't even know what, because that's where I want to stay when my house is getting fixed. It doesn't work like that. It just basically makes sure that you're able to maintain your current lifestyle, even though you can't be in your home. Like we have friends right now that had a pipe burst in their wall, like ruined the floors, like everything on the first floor, like it wasn't livable. So they're having to stay in a hotel. So they made sure that it's, you know, comparable. So you're not going from a really nice house to having to just stay in a Motel 6. Like they want to make things even and equal for you. So then you move to coverage E, which is your personal liability coverage. This is what protects other people who come into your home. So coverage A through D is all about you and your stuff, your things, you know, the money that you've invested in your home. Coverage E is where it starts taking care of other people. So I am super introverted. We don't ever have people over. I'm not a super people-y person. I'm not good at peopling. But if for some reason I did have somebody come over and they were visiting and, you know, they trip because my kids leave crap in the floor and they fall and they break their leg and now they have to go to the hospital. My homeowner's insurance, my liability coverage is going to step in and take care of them. There's, it's usually either 100,000, 300,000, 500,000. You kind of pick those limits. 300,000 is what I personally, that's the least that I'm going to put on your policy for you. Just because it's a difference of like $5 for 200,000 extra dollars in coverage. It just makes sense. Then coverage F goes right along with that, and that's medical payments. And so it is, again, it's going to be either 1,000, 2,500, 5,000, 10,000, and that's per person, per event, things like that. So again, $5,000 is the least that I'm going to put on there for you per person, because going to the hospital is stupid expensive. And you want to make sure that in case somebody sues you and you're having to pay all of these medical bills and all that kind of stuff, that you've got what you need and you're not having to come out of pocket for that. Like, that's why you have insurance. That's the whole point. So that kind of covers the basics of coverage A through F. I know that this is super exciting. Like, insurance is like, I know, right? It's like super sexy, super awesome. So that's the basics that you're gonna find on like usually the first page of your declaration pages. Then, so I talked about the additional replacement cost. I recommend that you find your deck pages either if you have a paper copy. If you have it online, I know a lot of carriers, everything is done online. You get discounts if you just have them email everything to you. Plus, it's better for the environment. Just throwing that out there. So you can go online, you can look at that, and if you don't see anywhere that says additional replacement cost or, you know, an enhanced package, things like that, call your agent. Say, hey, I just need to make sure that I've got that additional replacement cost. Another fun thing to look for is foundation coverage. That's also confusing because here in Texas, obviously, as the ground settles, foundation tends to crack. Like, you'll notice, you know, where your ceiling meets the walls, there'll be little cracks sometimes in the sheetrock, things like that. That is not what foundation coverage is for. That's just normal wear and tear. Insurance does not cover normal wear and tear. It covers like catastrophic events. So foundation coverage is, let's say a pipe bursts underneath your foundation and they come in and they're like, oh yeah, we're gonna have to drill through the foundation to fix that. That's expensive. So foundation coverage is there in case they have to tear up your foundation to fix a problem. It covers the cost to repair it. I recommend minimum of $10,000 in coverage there. Some companies don't offer $10,000, they stop it at $5,000. I would look to find a company that offers minimum of $10,000 because that you're gonna meet that $10,000 stupid fast if you have to deal with a foundation damage claim. It is what it is. It's a crazy expensive process. Another thing to look for is water damage coverage or water backup coverage. This is not flood coverage. This is not from water, they call it falling water or rising water. Like not rain, not the creek rising up and coming into your house. Does not cover that. It covers faulty plumbing. Let's say something gets jacked up in your dishwasher, you don't realize it, and there's a pipe it cracks, it breaks, and then all of a sudden, days later, you're like, why is the wood floor in my dining room buckling? Oh, snap, my dishwasher's leaked and it's ruined my floors. That's what that water damage and water backup coverage. Sometimes it's called hidden water damage or water leakage coverage, or slow leaks. It's things like that. It's not flood coverage, it's not rising water coverage, but it does protect you from plumbing issues, draining issues, if it messes up your walls or your floors, things like that. So with all of that, obviously you get your premium, but then you have to take into consideration your deductible. If something catastrophic were to happen, let's say we live in North Texas, a tornado comes through and it tears up your roof. What do you want to have to pay out of pocket to get that fixed? So that's where your deductible comes into play. You're going to have, coverage to fix that, but you're going to have to shell out something for that. Insurance is not going to cover 100% of it. So just keep in mind, the lower the deductible, the higher the premium for your annual insurance. But you kind of have to balance that out and say, okay, well, if I have a 1% deductible, which is 1% of that coverage A. So if you have a $300,000 house, 1% is $3,000. Say, okay, would I rather have, $3,000 that I'm paying out of pocket and a premium that's, here? Or would I rather pay $1,500 out of pocket and have a premium that's here? It's all in. Ask your agent. It takes them like 2 seconds to move those numbers around and look and just see and to be able to compare and tell you. It's our job. That's what we get paid for, is to make sure that we're taking care of you. So say, hey, I think I have a 1% deductible. Would that be different if we changed it to $1,500? Or, I really, I'm not worried about it. I'm good. Bump it up to 2%. Let's see how it goes. But keep in mind, in Texas, we have 2 separate deductibles. You have one that's called all other perils, and then you have one specifically called wind and hail. I want to say 85% of the time, if you're filing a claim on your homeowner's insurance here in our area, it's wind and hail. It's your roof. It's your fence. That's what it is. Texas, there are almost no carriers that will write below 1% on wind and hail. Some companies won't do less than 2%. Because of that, because you want to know what your options are, I recommend reaching out to an independent agent. They have access to more options. So let's say that you go online, you find a quote, and you're like, oh my God, like this price is great. Well, then you realize that company only offers a 2% deductible. And if you're like me, you can't afford to shell out 2% of, your dwelling coverage if something were to happen. That's probably why the rate is so good, because you would be paying more out of pocket and the carrier isn't having to pay so much out. Reach out to an independent agent. They can look at a huge variety of companies and just see what's out there for you. So make sure that you're taking into consideration both of those deductibles. Another thing to be mindful of is anytime you see ACV on a policy. ACV stands for actual cash value. You don't want that. You just don't. Actual cash value is what it would cost to replace part of your home or your roof or whatever it is, minus a depreciated value. So let's say your roof is 5 years old, which is still pretty new, right? But you have actual cash value coverage. You've got ACV coverage. A tornado comes, tears off the roof, and they're like, look, we're going to pay you for it because you have insurance, but because it's 5 years old, we're only going to give you like 82% of the value. Like, what the heck? You're paying good money for your insurance. Make sure that it's going to take care of you. You want to look for replacement cost coverage. You want replacement cost. Avoid ACV if at all possible. There are times when it's unavoidable. If your roof is over 15 years old, I can't think of a single company that will give you replacement value on it because it is older. A lot of times if a home is built before 1950 or 1960 and it's had like no updates done at all, a lot of times they'll give you actual cash value. But if you've done any kind of updates, any renovation, or the people who lived there before you bought the house did anything, let your agent know, because that can affect whether or not you're able to get replacement cost coverage. Stay away from ACV. It hurts my heart when I see people come in and they're like, here, will you review my policy? Just make sure that I've got what I need. This happened with my grandparents. I was looking, over their stuff saying, hey, let's make sure what you got, that kind of thing. The whole thing was actual cash value. If something had happened to their house, they would have gotten like nothing for it. And I almost lost my mind, and I was like, I want to call your agent personally and slap them, because my grandparents didn't know. They were just told, hey, we're going to save you some money on your premium. We're going to bring that rate down for you. They didn't let them know that they were taking away that coverage. be on the lookout. If you see ACV anywhere on your policy, on your declaration pages, holy crap, call your agent and say, hey, how much is it going to cost to fix this and get replacement costs? So yeah, that kind of wraps up home insurance. I've actually been talking about that for like 20 minutes. I know that that's probably too long to listen about home insurance, but still, it's good to know stuff. I have people, call in all the time, and I'm like, okay, well, what's your deductible? What are you, how much coverage do you have now? And they're like, oh, I don't know. Well, you need to make sure that you know, because, it's insurance is there for worst case scenario. It's something that you don't want to have to ever deal with, but if something were to happen, you want to make sure that you're not without it. Again, I keep going back to my parents, losing their house. Again, this was just a couple of months ago. It was a pretty new house. How old are my kids? Less than 10 years old. Custom built. They had picked out everything top to bottom. It was an incredible house. And it burned to the ground in less than 3 hours. It takes no time for bad stuff to happen. And you don't want to realize once it's too late that you're totally screwed and that you don't have the coverage that you need. Same goes for renter's coverage. Renter's coverage, you don't have to worry about a lot of the details of homeowners insurance. It's based on your contents, that personal property, the amount of, the value of the stuff that you have. Renter's insurance is, I've never, ever, even in the biggest houses people rent, I've never seen it over $100 a month. Typically, you're talking between $15 and $30 a month to make sure that you've got coverage for all of your stuff. When my husband and I first got married, we were broke. No money. Broke. And we didn't have, any renter's insurance, and I just assumed that we couldn't afford it. But we were living in this little Cracker Jack box, and we had basically nothing. But what we had, we needed. It probably would have cost us $5 to $10 a month for renter's insurance. And that's something that we could have made $10 a month happen to make sure that everything that we had was going to be, that we would be taken care of, that we weren't going to be stranded if something had happened to us. So just reach out. There are great agencies that are local. There are some here in Princeton. They're in McKinney, everywhere. I'm willing to help you out. Even just look at your policy for you and say, hey, highlight some lines and be call your agent about this. Let them know. I just want to make sure that you've got what you need. So moving on to auto insurance. Auto insurance is a little more basic. It's a little more straightforward. There's not as many variables because, with a home, you're trying to calculate exactly how much it's going to cost to rebuild and refill and all of that kind of stuff. With your car, Kelley Blue Book basically does that for you. You don't really have a lot of say in that. So the big thing with your auto insurance is your liability limits. So in Texas, you are required to have auto insurance. Not saying everybody does, but the law says you're supposed to have it. The minimum amount of insurance that you're supposed to cover or carry is, the state minimum is $30,000, $60,000, $25,000. So the first two numbers are bodily injury limits. $30,000 per person, $60,000 per accident, and then the $25,000 is property damage. That's other people's cars or mailboxes, anything that you could run into or damage that is not the person. That's the property damage coverage. Like I say, bare minimum is 30, 60, 25. 30,000, 60,000, 25,000. Unless you just demand that of me, I'm not going to write that for you because it takes almost nothing to jump over those limits really, really fast. Especially with us being in North Texas, there's a lot of, stop mocking me. My children are watching me and they are mean. There's a lot of really, really nice cars on the road. And if you are to hit a new BMW and you total it, that $30,000 is, that $25,000 in property damage coverage isn't going to go very far. You're going to be stuck paying a lot of out-of-pocket. Medical bills get expensive really, really fast. We talked about this with homeowners insurance. That $30,000, if something, like I said, if something bad happens and you cause a severe injury to someone, you got to make sure that it's not going to completely strip you of your livelihood, paying everything out of pocket. Plus, a lot of insurance companies, they look at those state minimums and they think, oh, these people are doing what they can to just skate by. We don't really want to deal with them. And a lot of times that can actually cause your rates to go up. So you would think by having the smaller amount of coverage that you're saving more money, but that's not always the case. So I recommend carrying at least $50,000, $100,000, $50,000. That's $50,000 per person in bodily injury coverage, $100,000 per accident, and $50,000 in property damage coverage. This can go all the way up to $500,000 across the board, $1 million across the board. I recommend anywhere between 50, 150 and 250, 500, 250. You want to make sure that's on there, because let's say you have a medical condition that you didn't realize was as bad as it was, speaking from experience, and you're driving home and you black out due to your medical condition and you obliterate your neighbor's basketball goal and gigantic brick mailbox. Yeah, now I have to pay for all that because that was me. That's where that liability is going to come in and take care of you. That's going to make sure that your neighbors get taken care of, that they get a new replacement mailbox. Really, guys, still so sorry about that. Y'all are amazing about it. Thank you for being so patient and understanding. It makes sure that they're taken care of. Now, the next part of it is uninsured or underinsured motorist. That is, again, how I talked about, you're supposed to have it, but not everybody does. Let's say you're driving, someone hits you, and it's like, oh, snap, I let my insurance coverage lapse because, whatever. And they don't have money to cover you, to take care of the claim against you, or against them, for the damage to you. Now you're on the hook for that. Do you want to pay out of pocket? No. If that person can't afford to pay out of pocket either, that's where your uninsured or underinsured motorist coverage is coming. Usually, I recommend matching that to whatever your liability limits are. In the state of Texas, you're actually required to have it on your policy unless you sign something acknowledging that you don't have it. They're kind of, sticklers about that. They want to make sure that you know that, you have chosen not to have that coverage. It also comes into play, let's say, if you're involved in a hit and run. A friend of mine I just saw, he was like, man, I was having a great evening. I had gone on a date. It was like our second date. And it went really well, blah, blah, blah. All this stuff is good. And then he was like, almost home. God, if it's not the kids, it's the dogs. And but he was almost home, and he was stopped at a red light. Somebody hit him, jacked up the whole back end of his car, and they just took off. They were gone. Uninsured, underinsured motorist coverage is going to come into play there as well. It takes care of you in case of a hit and run. That way you're not, again, if they don't know who did it, you can't force them to pay. That will take care of you there. Also in Texas, they require you to have what's called personal injury protection. That is what So liability takes care of other people. That's the third party coverage for the damage that you do to someone else. Personal injury protection takes care of you personally and your injuries. I ended up having to go to the hospital because of the accident that I had. Personal injury protection comes into play and helps take care of those hospital bills, the ambulance ride, things like that. State of Texas, again, you're required to carry at least $2,500 worth unless you sign something specifically saying, I am clearly specifically rejecting this coverage. Again, it's really usually not that expensive. Have at least $2,500 on there. It can go up. You can increase it up to like $10,000. And again, hospitals are expensive. Paying those bills sucks. Having that coverage on there helps take care of you. It also covers lost wages if you're not able to work. Again, up to whatever that limit is. Thankfully, I was able to work from home. But if I had been in a position where I couldn't work, it would cover, like I say, ambulance ride, hospital bills. It's also going to cover lost wages up to whatever your limit is. That's why, like I say, $2,500 is the minimum. You might want to consider bumping that up just because car accidents are really rough on you. They're not fun. They suck. Okay? And the injuries are awful. You want to make sure that you're going to be taken care of. However, let's say, you're older, you're retired, you're not worried about losing out on that income, that sort of thing. Maybe instead of personal injury protection, look into medical payments. It's very, very similar, except it doesn't worry about the lost wages aspect of it. So when you are, like 65 and older, you're retired, a lot of times medical payments can be less expensive. The next thing you're going to look at is comprehensive and collision. This is when people start saying things like full coverage. You're talking comp and collision. This is what's going to cover your vehicle. Comprehensive, or other than collision, that's going to be your windshield. That's going to be hail damage. That's going to be, anything that's not an actual collision. Damage to your vehicle that's not caused by some form of a collision. So again, it ties into, your deductible. How much do you want to have to pay out of pocket to get that fixed? Pretty standard is $500 or $1,000. And it works just like with the home. The lower your deductible, the higher your premium, the higher your annual rate is going to be. But it just kind of depends on what you want to have to pay out of pocket. Collision works the same way. That covers, let's say you hit somebody and you totaled your car, or you hit your neighbor's mailbox and you totaled your car. Collision coverage comes in then, and it will pay out the current value of your vehicle. They take into consideration the year, make, model, the condition of the car, the upgrades, the packages, things like that. They take into consideration your zip code, where you live, the value of similar vehicles within your area, and then they pay you the difference minus your deductible. So make sure that, some people, they're like, look, if your car's financed, you have to have comprehensive and collision coverage. Your financing company, they're going to be pissed if they find out that you don't have comp and collision, because they want to make sure that they're going to get paid if something happens. So in the case of my accident, I had just got my car this spring. So I only had it for a few months. Clearly not paid off. So they paid off the rest of my loan. That's, that collision coverage did. They paid off my financing, what was left. I got back the value of the vehicle over the top, of that, basically what I had already paid out, minus my $500 deductible. Again, some people are like, just put $2,000 deductibles on there. I want my premium as low as it gets. That's fine, as long as you take into consideration the value of your vehicle. The car I was driving beforehand, was a 2008 base level, vehicle that I bought when I was in college. If I was carrying $2,000 deductibles on that, I would not be getting anything back because, God bless it, it's not worth $2,000. It's not. So make sure that you take into consideration the value of your vehicle when you're thinking about that deductible. Like, is it worth having to pay out $500 if you've still got, $3,000 worth of vehicle? Yeah, like that makes sense to me. However, if you've got a $2,000 deductible, but you're like I did, and you have a $1,000 car, those numbers don't balance out. So make sure you're thinking about that with comprehensive and collision. Another coverage that you want to look at having is rental car reimbursement. This is rental car coverage only if you are to have a covered accident. This is not, I'm going on a trip, I'm renting a car, it's going to take care of that. Like, that's not what this does. It's, your vehicle is in the shop because of an accident, because of a claim, something like that. It will cover a rental car for you. It's usually a specific dollar value per day. You can have it $30 a day, which is going to be a very basic, economy car. You can have it up to, $50, $75 a day, which is going to be a nicer vehicle. Kind of depends on, if you've got 3 kids, or, you're like me, you got 2 kids, and 3 dogs that you might need to haul around. And you want to make sure that that rental car coverage value is going to cover a vehicle big enough in case you need it. Another fun coverage that carriers put on for you, and they're like, oh, it's super cheap, it's only like $5 for the year, is roadside assistance. This covers, let's say your battery dies and you need somebody to come jump you off. You lock your keys in your car while you're out somewhere. They'll send someone to unlock it. You run out of gas. Something happens and you need to be towed. That will cover that. However, I would recommend not having that because even though it is inexpensive, it can come back to bite you in the butt really fast. Every time that you call your insurance company and say, hey, I need somebody to come jump me off, or hey, I need a tow, my car won't start, or whatever, that counts as a claim against you. Even if it's only paying out, $40, $50, $75, $100, it still counts against you. And if you ever try to look to move to another company, trying to save money, that sort of thing, they can go, oh, well, in the last 5 years, you've had 7 claims. And you're like, the grand total of it was like $600 over 5 years. They're like, no, but that is, 7 separate instances. Even if it was just something small. I highly recommend looking into AAA for something like that. Overall, in the long run, it typically ends up being cheaper. That way, you don't have to worry about having a claim that counts against you. Because anytime you put a claim on your policy, it sticks with you for a minimum of 3 years. Up to 5 to 7 years. But a minimum of 3 years. So, something happens and you lock your keys in your car one time, insurance companies are going to look at that for at least 3 years. I also recommend investing in a Pop-A-Lock kit from Amazon. They're like $30. I have one that I keep at my house and one that I keep at my desk at my office because I lock my keys in my car all the time. You don't want to have those kind of claims counting against you. Again, look into AAA. It's, in the long run, much more affordable, much more economical than having it on your insurance policy and having those claims count against you. Let's see, another thing that you can do to make sure that you're saving as much as you can, we were talking about those liability limits. Let's say right now you do have state minimums. You've got the 30, 60, 25. And you're like, yeah, but I want to move to a new company. I don't like the company I'm with. They don't have great service. They this, that, or the other. Whatever. But you want to make sure that you're getting a good rate at the next company. Consider raising your limits for 30 days. Say, okay, well, you know what? I'm going to leave my company. Today's, January 16th. I would like to leave by the middle of February. call your agent and say, hey, I've been thinking about it. Let's increase my limits to 5,100. I want to show that I'm more responsible. That's what carriers look at. For having that for 30 days, the premium increase is usually pretty minimal. It can make your rates in the long run decrease. You would think that having more coverage would end up being more expensive. That's not always how it works. Carriers want to see that you care about making sure that you're taking care of drivers around you. So if you carry more than state minimum limits, companies tend to smile on that. So if you want to make sure that you're getting a good rate and you currently have state minimums, look at bumping those up for 30 days. That's enough for it to be on your insurance history, because carriers look at your credit. They call it an insurance credit check. It looks at your credit history, a soft pull, not a hard inquiry. It just validates financial responsibility, but it looks at your claims history and your insurance history. They want to make sure that you've had continuous insurance. They want to make sure that, you have the limits that you're saying that you have. So 30 days is how long that takes. Another thing that you can look at to save on your insurance is looking at a telematics program. You see those advertised all the time. Progressive has Snapshot. Not AT&T. Allstate. Oh my gosh. Allstate has DriveWise. Nationwide has one. The company I'm with, they call it Mercury Go. The majority of companies have it. What it is it's an app on your phone. It runs in the background while you're driving. And a lot of people are like, oh my God, it's going to be tracking me. They're going to know where I'm going. I don't want them to know that. Oh my God, I almost fell over. Yeah, if you're planning on committing any crimes or anything, maybe don't use telematics, because yes, it does track your driving history. But outside of that, I'd say you're probably pretty safe. It's no different than having location services turned on for any other app. They typically use very little data and very little battery. Most companies give you a discount of minimum 5% for signing up. Usually it's 5 to 10% for signing up. And some companies, some of them do it for 45 days, some it's 90 days, some it's your entire policy period. But they look at those driving habits. They look at your speeding. They look at hard braking, if you're slamming the brakes. Are you driving at 3 a.m. frequently? Sorry, my puppy again. They look at that, and the more positive driving you have, if you're not going over 80 miles an hour, if you're not slamming the brakes, if you're driving in daylight hours, some companies will offer you a discount of up to 40% when your renewal comes around. That's a pretty significant, price, at least in my opinion. I'm all about saving money. So if I could save 40% on my insurance, I'm down. The only thing to look out for is if your company surcharges you for bad driving. Some carriers do not. They don't care if you drive like you're in NASCAR 80% of the time. They're going to reward you for the 20% of the time that you don't drive like you're in NASCAR. They just, want to encourage you to drive as safely as possible when you feel like it, and they'll reward you for it. Some companies, there's going to be a negative impact. They will raise your rates for negative driving habits. Make sure you ask your agent, hey, I'm using Progressive Snapshot. Let's say I get a wild hair and I'm driving 120 miles an hour down 121 at 2 a.m. because nobody's out. Is that going to come back to bite me? The answer is yes. Yes, it will. If you do the same thing with Nationwide, no, it won't. Different carriers look at it differently. Make sure you ask your agent, have them clarify on those telematics if there's any surcharges. So that's kind of the basics of auto insurance, and just kind of make sure you have what you need. Ideally, more than state minimums, and some ways to, try to save. If you've got any questions about it, feel free to either leave me a comment or you can message me. You can add me as a friend on Facebook. That's fine. I'm happy to look over everything for you and like not even trying to get business. Like I will look at it and say, hey, this is what you need to call your person about. Just that way you can make sure. Again, I have personally seen in the last 2 months how important it is to have good homeowners coverage and good auto coverage. Both myself and my family, we would be in a really, really bad spot if we did not have, if we didn't have good coverage. And I'll go ahead and tell you, my parents aren't, I don't insure my parents. I looked over their policy about a year and a half ago, I guess, a year ago, and I looked at it and I was like, yeah, I can't touch that. Like, you've got a good rate, you've got your agent has done a good job of making sure you have everything you need. Stay put. And it ended up benefiting them. They've been with the same agency for 35 years or something ridiculous like that. I'm happy to do the same for you. You can black out the prices. If you don't want me to know how much you're paying, that's fine. I don't care. I can just look for some of those keywords for you and say, hey, I think, you might want to call and ask about this. You might want to double check and get some clarification on this. I'm also happy to help out if you need help with, let's say, an umbrella policy. Go ahead and throw this out there. If you have a swimming pool, you need an umbrella policy because I don't even like saying it out loud, but let's say someone were to drown, your homeowner's liability is not going to cover what you're getting sued for. You need to have an umbrella policy. If you have teenage drivers, you need an umbrella policy because, I used to be a teenager too. They're not the best drivers. Something about that just kind of happens. You want to make sure you have an umbrella policy. I can kind of help you make sure that you understand what to ask your agent for. If you have pets, I can help you know what to look for pet insurance. I thought that was only for the crazy dog moms that carry their dogs in purses, which I've actually become in the last few months. Don't judge me. But pet insurance is huge. I found out the hard way about a year ago after losing one of my pets because, we still ended up having to put him down and I was out a stupid amount of money that I really don't want to talk about. Having pet insurance can take care of that. I'm happy, like I say, just to make sure, and give you advice on, hey, this is what you need to ask about. This is what you need to look for. Again, I recommend going with an independent agent because they can look at a variety of options for you. They are skilled in knowing which carriers have a sweet spot for, what type of properties, what type of vehicles, things like that. Like I say, there's more options. A lot of times they call them brokers or brokerages, but an independent agent. And always compare. When you're looking for new insurance, don't just go with what's the cheapest option. Because just because it's cheap does not mean that it is good. And just because it's expensive does not mean that it is good. You want a variety. You want to look at least 3 different companies. Comparing those rates, the dwelling coverages, your liability limits, all of that kind of stuff. At least 3 companies. Again, that's why I recommend an independent agent because most of them have between 5 and 20 different companies that they're looking at. They can kind of compare it all for you, saves you a lot of time. Because as y'all have learned in the last 50 minutes, insurance isn't super exciting. So yeah, I just want to make sure that you've got what you need, that you're taken care of. If you have any questions at all about your insurance, feel free to ask me. This is what I do day in and day out. Every single day. I'm driving down the road and I'm looking at houses and I'm like, I wonder what it costs to insure that. Ooh, look at that kind of roof. I bet that. I'm lame like that. That's my life. I think about insurance pretty much all the time. So I'm happy to help out in any way that I can. Thank you guys for watching. For those of you that did, again, sorry if it's confusing or boring or anything like that, but there you go. That is Insurance Basics 101. Goodbye.